Let's get in a special voice. Ajay Srivastava, he's Managing Director at Dimensions Corporate Finance, joins us right now on the show. Ajay, good having you. Been a while, but thanks so much for joining in. What's been worrying you? Is it the global fears? Is it what's happening within the country on a social level, which might also have an impact on the market sentiment? Or is it that earnings, while they started off well, have shown some chinks in the armor in select pockets?
I think in terms of worry, I don't think, we use the word worry too much, because I think what we use the worry word is caution. And I think the caution is very evident that there is a specific set of stocks which have done well. If including IT, there's only 1 out of 3 which did well. In consumer space, you're seeing well. But the caution is that the big guys, they are the ones which are having trouble. When I say big guys on a day like today, if you're talking a little negative, is if you look at what's happened to the two-wheeler industry, if you look at what happened to the bellwether banks, they have never reported numbers of this kind ever. This is perhaps the shallowest growth rate they have reported in the history of 2 of the bigger banks, the HDFC and the Kotak. So that segment, the two-wheeler segment, both are giving out red lights and caution. There are, of course, re-rating stories like Reliance, etc., which give you confidence that things are going to do well. There is a pocket called Bajaj Twins, which has done exceedingly well in performance. So what you're seeing is really rich. Caution is skewed performance across companies. It's not that the market in unison is going great. It's very skewed performance of maybe 15-20% of the companies, and they are gaining the traction. So you got to be very careful in this market. This market is not re-rating itself. This market is picking up winning and losers, and then saying stay with us as the winners. If you still want to value pick with losers, I think this market will penalize you much further than what you've already been penalized in the last 1 year. So that's the only spirit. Rest good for the market. I think it's become a relief for all investors. It's recovered a little bit, but I still believe that it's caution for non-performers, because value picking non-performers could be the most dangerous part of the strategy in the next 6 to 9 months.
Ajay, hi, good morning. This is Darshan here. Are you cautious about the valuations that,
Good morning.
Good morning. Certain stocks are quoting because the counters that seem to be moving up are high value, they're trading at new highs, while the low valuation stocks still continue to plummet. You have the Bajaj Twins, you have Asian Paints, all these counters trading at record highs, TCS trading at record highs. So it's a select few stocks that are helping the Nifty move in higher, and valuation again there is getting stretched. Is that a concern?
It's not a concern, and I think the reason it's not a concern so far is the fact that these are primarily under-owned stocks by a large amount of retail in this country. And number 2 is their results have been astoundingly good. Now, if you look at Bajaj Twins, look at the results. We're talking of 80% kind of growth rate. Even if you give a P of 40, 50, yes, it's excessive P. I would grant you that. And if any correction comes, you buy it up. But the fact remains that these counters are showing exemplary growth. The problem comes that when the biggest bellwether of this market, which is your HDFC Bank and Kotak Bank, which are the two-wheeler company which are showing so much of traction, they start to slow down. Let's see how Maruti results comes around, whether that has got a problem on the margin front because of given the discounts and the raw material price increase, whether they have a problem or not on the volume front, but on the margin front. So it's not, I would not worry too much with the performers. As I said, aggressive built up on performers is the right strategy for a market. This is a market for growth stocks. This is not a market for value stocks, because low valuations are coming from somewhere. And I think one place they're coming from is their low traction, their low competitive strength in the market. And therefore, you do not want to go and pick those ones, because the market is hostile to them. The environment is hostile. Economy is hostile. You're not seeing any relief coming to those counters. The credit delivery system they're going into further and further problems as we go down the path. You already seen the commentary of the MD of Kotak Bank, which says that the SME problem is now coming to the fore. Economy takes time for things to happen. The demonetization, GST impact is now starting to come into the trading companies and the SMEs. Now, when that happens and the credit flow cycle starts to slow down, you'll see a lot more problems. So as I repeat myself saying, Yes, you're paying higher for growth stocks, but that's still a wiser strategy than buying cheap the value stocks which are in trouble at this point of time and perhaps will go into greater trouble. So look for the revivals, look for the performers. Doesn't matter you bought a little extra, paid a little extra, you're a little late in the game, but at least be there so you will not see huge cuts in your portfolio compared to what we have seen the last 1 year. So don't worry about expensive stocks. Those are the growth stocks. Keep with them. They will be fine.
Ajay, it's difficult to make a sell call, if you will, allow me to use that term, on any of these performers, be it the Bajaj Twins, the HULs, Britannias of the world, or select banking names as well. The question is, could we finally witness a time correction in these names? We've seen that happen to the FMCG names for the better part of the period preceding this last 18 odd months. Could we see that happening to the large financial names, select FMCG names, the ones which are trading at this 50, 55, 60 times on a PE basis, or an astronomical 8, 9 times on a price to book basis?
You know, Neeraj, you're right. The risk is there that you could see a time-wise correction, or at least remaining static doesn't give a great return to it one. But if you look at the portfolios of customers, look back last 1 year. If you look at FMCG portfolio, you may be right that they haven't done exemplary well. They've given a decent kind of return. But then you compare to what's the mayhem all around you in the mid-cap sector. We're talking about 40, 50, 60, 70% kind of a bloodbath. So, from an investor perspective, you would rather trade in. I think that's the more important point. People have to understand that most investors that we deal with, or at least we advise with, we say, stable returns on a low risk basis is better than a high return on a high risk basis. It depends upon the profile of the customers. But by and large, most customers, in my view, would try to not to have a slash in the portfolio of the kind that we've seen, and would rather be happy with 18-20% return. Remember, we came from a background of 5-6% FD interest. Now it's 7-8%. So from 5-6% FD interest, if they were getting 14% return, they were a pretty happy bunch of people. Maybe 19% very happy. They were not looking for 40%. Now the people who are looking for 40% are the ones who are in really the mid-cap game, and that's a game which I am told plays out over a period of 3 to 5 years. So it's 1 year is too short a duration to take a call whether the call was right or wrong. The number two, it will see its own vicissitudes over time. Volatility will be very huge, so you need to live with the volatility. And therefore, while there could be a time-wise consolidation of these stocks, I would still believe you'll be a happier camper in this camp than being in the camp which can take away. And the next problem is in mid-cap is 2 of the stocks can be stellar, but 2 can be a disaster, and they average out. So, you could have a great stock and then you have a weak stock, and then you see what happens. You could have a PCJ in your portfolio, which could wipe you out completely, all the returns and everything else. So those are the risks. So I am saying risk-weighted return in order of the day. Risk-weighted return tells us growth stocks is the story. You may have a time-wise consolidation, and believe me, if these stocks don't perform for the next 12 months, there is little hope that the smaller guys will perform. It's not going to happen. The leaders have to take the charge. It's like the infantry. The artillery has to move forward before the inventory can move. Inventory can't go ahead of artillery.
Yeah, well, that's well said. So, Ajay, then my question to you is, when you are now, if you are starting to buy now, I'm presuming that you would be, are you buying the ones which are on sale, 20, 30, 40, 50% off their valuation highs that they've clocked in, or are you sticking to the ones which have performed thus far? And if you are indeed buying the ones which are on sale, where is it that you're finding value? Where is it that you're finding possibilities of strength going ahead?
See, if you look at across every industry, there are stocks which still have tremendous value. Whether you look at pharma industry, which has got offering a lots of scope for value at this point of time, there are lots of stocks for value. Now, whether you look at auto ancillaries, there are a couple of names which are giving you value. You also had a very mediocre performance of Jai Bharat. You have exemplary performances of Minda, which will come around. Last time it was exemplary, maybe this time it will not be happen. So, it's not about pockets, it's about stocks. In every pocket, you'll find a slow mover, a dud, and a fast mover. And I think the trick is to go with that and don't do very fancy analysis. Just look at the June quarter results. Where you see a winner, go and place your bets. Yeah, you may have already lost 20% return on that one. Live with it, doesn't matter. You're not buying for tomorrow morning. But focus on the fact June is your indexes. If June result is not good, jettison the stock, get out of it. So my view is, and what we have bought and this thing is, that those are the pockets you got to be with. Number two, of course, is, you know, the whole debate upon the biggest stock in this country, Reliance. Now you can have a camp. I'm not advocating buying Reliance because I'm not going to advocate any stock. But the fact is that can you live without the largest stock in this country? Fact is, can you live without the top 5 of the performing stocks in this country? Now that's why I said there the problem has come that 2 of the big stocks, HDFC and Kotak Bank, unfortunately did not show a stellar result of what they were expected, because one thought it'll be a clean walkover for them. With Nationalized Bank in paralysis, they would report exemplary results. They have not. They are struggling for deposit. They have raised the rates over Nationalized Bank for the first time in a decade. Foreign bank and private bank rates of deposits are now higher than nationalized banks, and that's eating into the margin. So let's see how it plays out. But I would say June quarter result should be your trigger to say, if it's done well, I'm with the stock. If it's not done well, I'm not going to buy it. Maybe there is a turnaround. I don't care. I will not buy this stock.
I think this is the highlight of this conversation today with Ajay Srivastava. 2 things that stand out for me. Don't do fancy analysis, and remember, you're not buying for tomorrow morning. Ajay, it's such a pleasure having you as always. Thank you so much for taking the time out, and look forward to have you more often.
Wonderful having you.